Good morning, and thank you for joining us today. I'm Jen Kahn, Corporate Director of Marketing for Bridge Tower Media, Central Penn Business Journal, and Lehigh Valley Business. Here with me today to talk about the financial aspects of navigating important life transitions are Jim Karshner and Scott Michael of Damani Wealth. Before we get started, I have just a couple of housekeeping items to cover. First, this presentation is being recorded, and you will receive a link to the recording by email later today for your future use. Also, we will be saving time at the end of the presentation to answer any questions that you might have. Although you're in mute mode, you can submit a question at any time by using the questions widget in your GoToWebinar control panel that appears at the side or top of your screen. Open up the questions box by clicking on the arrow next to the word questions and type your question into the box. We will receive the question immediately, and it will be answered at the end of the session, time permitting. And with that, I'll hand the mic over to Jim Karshner, Partner and Senior Wealth Advisor for Damani Wealth, for the main event. Welcome, Jim.
Thank you, Jen, and welcome everyone to the webinar this morning. We appreciate everyone coming. We're going to be talking about navigating life's transitions, really kind of looking at it from the financial impact of many different things that happen throughout one's life. Some of those things are planned for, some of them are not planned for, but essentially, the topics that we're going to be covering today include changing jobs, business succession, which really is transitioning a business if you own a business, divorce, retirement, long-term care, the death of a spouse, and an inheritance. Those are the 7 topics that we're going to be talking about. And Scott is going to start us off talking about changing jobs. Scott Michael, who's also a partner in our firm, Damani Wealth, and he's going to be talking about the first 2 topics, actually changing jobs and business succession. So go ahead, Scott.
Good morning, everyone, and thank you, Jim. Wanted to talk about the implications of changing jobs, and particularly as it relates to your 401k plan. When you change jobs, you need to decide what to do with the money that's in your 401k plan. Should you leave it where it is, take it with you? Should you roll the money over into your new employer's retirement plan? As you consider your options, keep in mind that one of the greatest advantages of a 401k plan is that it allows you to save for retirement on a tax-deferred, or in the case of a Roth, a tax-free basis. When changing jobs, it's essential to consider the continued tax deferral of these retirement funds, and if possible, to avoid current taxes and penalties that can eat into the amount of money that you've saved. So we really need to look at which option's right for you. As you can see on the screen, we talk about taking the money and run, or we talk about leaving the funds in the former employer's plan, transferring funds to the new employer's plan, or transferring funds to your IRA. So let's start with taking the money and run. In this case, you're simply instructing your plan administrator to cut a check, and you're free to do whatever you please with the funds. This is often called a lump sum distribution. Part of the problem with this is, while cashing out may be tempting, it's almost never a good idea. It significantly will reduce your retirement funds. You'll have to pay federal income tax on the distribution. You may be subject to a 10% premature withdrawal penalty. And taking these funds may drive you into a higher marginal tax bracket as well. So this is often not a good choice for most people. Let's talk about leaving the funds where they are. One option when you change jobs is to simply leave the funds in the old employer's plan, where they will continue to grow tax deferred. However, you may not always have this opportunity. If your vested balance is $5,000 or less, your employer can require you to take your money out of the plan when you leave. Another option to look at is the transferring your funds to your new employer or an IRA. These would oftentimes be referred to as a direct rollover. Transferring the funds directly to your new employer's retirement plan or to an IRA instead of withdrawing your funds when you leave your old employer can transfer them directly to your new employer's plan if the plan allows. Not all plans will allow that. You could roll the funds to a rollover IRA instead of to the employer plan as well. Another option in there would be to do a Roth conversion. That you might consider converting some of the funds into a Roth. It's important to note that if you have Roth 401k funds, they can only be rolled to a Roth 401k, a Roth 403b, or a Roth IRA. So you have to consider that as well and consider the sources of the funds inside your IRA or your 401k when you're making this decision. The best way, however, is to roll over the funds directly from the trustee or custodian of your old employer's plan to the new plan or IRA. This avoids the required 20% federal withholding and is a much cleaner way to approach the transfer of the funds. I will talk briefly here about there is an indirect rollover often referred to as the 60-day rollover. This is when you have the distribution check made payable to you, and then you deposit the funds in your new plan or IRA. By having your distribution check made payable to you, though, it forces your old plan's custodian to withhold a minimum of 20% for federal income taxes. If you subsequently deposit to your new plan or IRA, then you will have to come up with the other funds to deposit that 20% that was withheld. So, for instance, if you had a $100,000 balance in your old 401k and you had them make the check payable to you, you're going to get a check for $80,000. The other $20,000 is getting withheld and sent to the IRS. And if you want to get a full distribution back into your new plan, you have to come up with that $20,000 to make that a non-taxable event. And the funds must be redeposited within 60 days in order to be considered an indirect rollover. So when we talk about which option is appropriate, there's a number of things to consider. You have to weigh the pros and cons to each approach and find the one that best matches your objectives. This is where an advisor can really help you navigate. Some of the considerations might be that a traditional IRA can offer almost unlimited investment choices, where retirement plans oftentimes have limited choices. The choices are vetted out and narrowed down in retirement plans, where they are not in the IRAs. Here's an important consideration. ERISA plans, which are often 401ks, 403bs, etc., may offer greater levels of creditor protection, something many people are not aware of, but it's important to consider the creditor protection that goes along with retirement plans. Another thing is a 401k plan may allow for penalty-free withdrawals if you leave your job at age 55 or later. These are generally not available from IRAs until age 59 and a half. So again, another consideration depending on your needs. In a retirement plan, in an IRA, you must take your required minimum distributions once you reach age 70 and a half. Where in retirement plans, in many cases, you generally are not required to do that until you retire. If you have a 401k or a retirement plan that has employer stock in, the employer stock may be eligible for more favorable tax treatment when distributed from the plan rather than an IRA. So there's some strategies around dealing with employer stock. Some 401ks may offer loans. If you have a loan on your 401k and you leave the employment of your employer, you need to consider how to deal with the loan at the time you leave your old employer. You may have to either pay it off immediately, or it may become a deemed distribution. So just a few things to consider about when you're changing jobs and what to do with your 401k plan. Now moving on, let's move on to the next topic here, and that's business succession. And that's a pretty big undertaking, but we're going to keep it relatively simple here in the sense that business succession planning is when and how to step out of the business. One of the most important decisions a business owner will make is when and how to divest themselves of their business interest. To develop a plan for succession, there are two basic choices. Either you sell your business interest or you gift your business interest. There are numerous approaches to transferring a business interest. Some of them that we're going to focus on are: one, the use of a buy-sell agreement; two, the outright sale of the business; three, the transfer of ownership through lifetime gifts; or finally, the transfer of ownership at death through your will or trust. Using a buy-sell agreement, this is a legal contract that prearranges the sale of your business interest. It allows you to keep control of your interest until the occurrence of an event specified by the agreement, such as death, disability, or retirement. Other triggers such as divorce or bankruptcy could also be included as a triggering event in a buy-sell agreement. But a buy-sell agreement provides a ready buyer and predetermined terms, for example, price and payment schedule. The prearrangement of the terms may avoid negotiating these terms when there is no pressure to sell, which can be beneficial. So buy-sell agreement is one way to tackle the transition of business interests. Let's talk now about the outright sale. So selling your business interest outright. Multiple considerations here, as you can imagine. An outright sale allows you to make the decision when you want to sell and negotiate the terms based on the current state of affairs in the business or the environment that you're operating in. Things to consider are, if you're selling your business, you may have a limited market and your business may be difficult to sell. The size of your business may influence the sale. A larger business, for example, may be harder to find buyers that have access to enough capital. There may be other estate considerations as well. Minority interest in a business, on the other hand, may be more difficult to sell because it lacks sufficient control. So let's talk now about transferring your business interest through lifetime gifts. Lifetime gifts would be a way in which you can transfer some or all of the business through a gifting technique, and there's multiple gifting techniques that could be utilized. This helps to retain control longer, presuming you're giving away partial ownership interests. You can also take advantage of the annual exclusion gifts, which allows you to gift away some of your business interest without having any estate tax implications if that were part of your financial situation. The final thing that we're going to talk about here is transferring your business interest at death. If you wish to keep control of your business until your death and transfer your interest to someone at that time, you could transfer your business interest at death through your will or a trust. This method of business succession can be effective when the intended receiver of your bequest is currently active in your business and would be able to assume the business responsibilities. The various strategies discussed above here can be used to achieve specific goals for your business interests. Depending on your specific situation, one or more of these approaches may be appropriate for you. Again, business succession can involve complex tax, legal, and family dynamics. Having an appropriate team of advisors is critical to ensure success. Now we're going to turn it over to Jim to discuss divorce.
Thanks, Scott. So divorce is one of those transitions in life that I don't think we typically plan for, either before we get married nor during our marriage. But it is a fact of life that a fairly high percentages of marriages end in divorce. So there are some key things that need to be considered, and if you're facing a divorce, things ranging from hire an attorney and legal fees to how do you not only determine what all of your property is, but how is it marital property or is it separate property? Will there be a need for alimony? What kind of debt is involved with the marriage? What kind of retirement plans do you have? What are the tax ramifications? If you have children, there's going to be custody and support issues. How does this impact also your risk management, which would be your insurance coverages and things like that? And then if you're older, how's it impacting your Social Security? Those are the key things that are going to be you're going to be faced with when you're dealing with a divorce. Just quickly, I want to talk about what a community property state is versus an equitable distribution state. There's really only a handful of community property states, that being Louisiana, Arizona, California, Texas, Washington, Idaho, Nevada, New Mexico, and Wisconsin, as well as Puerto Rico. But generally, in a community property state, essentially anything that you acquire during the marriage is considered to be equally owned by both spouses. That's not only the income that's earned, but also the assets that are acquired. And generally, in a community property state, when you get divorced, that community property is split 50-50 between the spouses, just by virtue of the law. Equitable distribution states, which is Pennsylvania and most other states, are considered equitable distribution states, and essentially that looks at, in a divorce situation, splitting up the assets not necessarily equally, but equitably or in a fair manner. And that could mean that one spouse gets 60%, one spouse gets 40%. It could be 50-50. It could really be anything, but it's decided upon based on a fairness attribute as opposed to just a 50-50 split. Now, what is marital property when you're looking at the divorce situation, trying to split up the property that is owned by both spouses? Marital property essentially is anything acquired during the marriage. So that would be anything that you had after you got married or that you acquired after you got married, versus separate property would be things that were either acquired before the marriage or after the marriage, or things that you obtained during the marriage by gift or bequest or inheritance or those kind of things. It also would include anything you would have put into some sort of prenuptial agreement, would be considered separate property. So marital property would be what we would be looking at, in a divorce situation. How do you split that up in an equitable distribution state or a community property state, depending on your domicile. So going through a divorce, some of the other factors that I mentioned earlier, but that are key here. If you have children, you're going to need to decide on custody of those children, and then what kind of support that one spouse may have to pay to another spouse. And that doesn't always happen, but in most cases where there's children, there's usually a support calculation. And I know in Pennsylvania that's a calculated amount that's based on a number of factors, including income and those kind of things. Do you have a need for alimony? And again, alimony is something that's changing here because of recent tax law last year that essentially changed the deductibility of alimony by the person paying it, and it no longer needs to be included in income of the person receiving it. So alimony is typically awarded, at least in Pennsylvania, to based primarily on a need, where you have a spouse, one of the spouses that really hasn't worked or has been in the home, doesn't have the education, and there's certain reasons that alimony would be awarded in those situations. But now that the deductibility and inclusive alimony and taxable income is no longer an issue, you may see more divorces kind of resulting in more support related kind of issues, and child support payments or spousal support payments are never deductible or never deductible by the payer or includable in income by the recipient. So those are the primary things in terms of taxation. I mean, there's a number of other things in terms of taxation you need to consider, and that depends on the assets that are being split up, whether they're stocks and bonds or whether it's property or whether it's retirement plans. There's all different tax ramifications to those that you probably need to consider. One final thing that I wanted to discuss with respect to a divorce is, more and more people, I think, their primary assets are tied up in, you see them tied up in retirement plans such as 401ks, like Scott was discussing. And you may have a situation where, where the main income earning spouse has a big retirement plan, but there really isn't a lot of other assets beyond that. So, what do you do in that situation? And there's something called a qualified domestic relations order, or short QDRO, that would need to be considered, where what a QDRO is it's a legal document that needs to be prepared by an attorney and approved by a judge, but essentially lets you take part of a retirement plan and split it out for the other spouse, either through a transfer to an IRA for that spouse, or if that spouse has their own retirement plan, or like we mentioned earlier, you can do it in a lump sum if you wanted to. So there's many different tax ramifications to that you want to consider. If you're faced with with a situation where there's going to be a need to do a QDRO to split up the assets equally. Transitioning over to the next topic, which is transitioning into retirement, and that's a life transition that hopefully most of us are expecting and preparing for. Although I heard on the news this morning that the statistic that 48% of individuals over age 55 have nothing saved for retirement at that age, which is a little scary. But for those of you that are saving for retirement, considering retirement, the transition into retirement, is a very important part of your life. And as you're approaching it, things like, can you afford it? Do you want to retire early? Do you want to delay retirement? There's emotional, not only financial components, but there's emotional components to it. What's Social Security going to mean to you? Annuities, health care, and then kind of dealing with your own IRAs and 401ks. Talking a little bit about the financial versus the emotional component. I mean, most of us think of retirement, we're looking at it from a financial standpoint. Can we afford to retire? Will our money last, our lifetime? Is it going to give us enough income to maintain our lifestyle during retirement? Have you looked at contingencies and so forth, and kind of build all that into your financial plan? But the other 50% of that decision is the emotional component. Are you ready to retire and enter this new phase of your life from a psychological standpoint? You've worked for 40 years and gone to a job for 40 years and kind of been doing that for 40 years, and for 35, 40, however many years, and all of a sudden to just stop that, there's some pretty significant emotional, kind of psychological issues that you need to kind of be prepared for, where you get up every day and you don't have anything to do. So you want to have something to do. You want to have something to kind of fulfill you and take the replace what the job was doing for you in terms of that emotional component of your life. So you need to make sure you think through those aspects and kind of have a plan in place to deal with that side of the retirement equation as well. This slide talking about timing is everything. How long should you plan for? I mean, how long typically, if you're retiring at age 65, what's the time frame you should be looking at? If you're retiring early or you're thinking of retiring early, what does that mean in terms of when we're going to do it and how long we need to plan for? Same with postponing retirement. It changes the equation significantly. Statistically, the average male life expectancy today is 76.3, female is 81.2, but as an age 65-year-old person right now, men's life expectancy is to 83, women is to 85.6. So, you're looking at least probably 20 years worth of retirement that if you're going to retire at 65, that you have, to plan for. If you're retiring earlier than that, then you need to really be looking at, 25 or 30 years or more, depending on the age that you're looking at retiring. So those are the kind of the time frame that you're thinking of. In terms of if you're going to retire early, you may be giving up what are the downfalls of that? You may be giving up prime earning years. If you're retiring at 55 and from 55 to 65, maybe your prime earning years, but if you're going to stop earning or you're going to stop working, then you're kind of giving those up, in which, prime earning years convert into, prime saving years as well. So if you retire early, obviously you need to increase the number of years that your savings needs to last. Inflation and purchasing power becomes a bigger impact, has a bigger impact on your life. Social Security benefits, when do you start collecting those? You do it early at age 62, which is the earliest you can take them, or do you wait till, age 67 or 65 or 66, or do you wait all the way to age 70? What do you do with your employer pension? If you've got a pension, can you defer that, and are you allowed to start taking it early, those kind of things? If you're under age 59 and a half and you're going to withdraw money from IRAs or 401k plans, you need to be careful how you do that to avoid, the pre-59 and a half 10% penalty on those. There are ways around that. Another big issue is medical, is health insurance and medical issues. Right now, Medicare does not kick in until you're age 65. So if you're retiring prior to that, then you're going to have to come up with money to pay what could be pretty substantial premiums during that window between retirement age and age 65 when Medicare would kick in. Now, Medicare doesn't cover 100%, but it certainly takes on a big chunk of your health care costs. So those are the considerations if you're looking at retiring early that you need to kind of be aware of. If you're thinking of postponing retirement because either you enjoy working too much or you're in you're in your dream job or those kind of things, there's obviously a number of advantages to that, because you can let your savings grow longer. You can defer more into your retirement over those years that you're working, which will help build up your savings, and it helps to ensure a more secure retirement in that you have a shorter time frame, a shorter period that you have to actually have your assets, your savings kind of produce income for you over versus retiring early. It creates additional transition time. If you start thinking about it at age 65 and you're going to pull the trigger at 68 or 69, whatever the case may be, it gives you a little bit more time to think about it. Allows you to potentially delay Social Security benefits, which, again, if you take them at 62, you're taking about a 25% permanent reduction in what you otherwise would have received if you waited to your full retirement age, which in most cases that's 66 or 67 for most people today. But if you can wait till age 70, you get an 8% bonus each year that you wait beyond your full retirement age. So if your full retirement age is 67 and you wait 3 additional years, you're actually getting 24% more than you would have had you taken it at 67. So again, there's advantages to that. You can defer your IRAs, withdrawals from IRAs and 401ks and the like to age 70 and a half, as Scott mentioned earlier. This may allow you, by deferring or you're postponing your retirement, to defer that a little bit more, a little bit longer. Now I'm going to transition back to Scott here, and he's going to talk about long-term care.
Okay, so long-term care, and we're going to break this out into two major parts. First of all, thinking about this as facing an incapacity or a long-term illness. Unfortunately, illness can strike anyone at any time. So planning ahead can ensure your wishes are carried out. And that could be during your working years. That could be a matter of carrying appropriate disability insurance to replace income. But it also could be paying for your care and support during such an event. First of all, though, let's talk about managing your medical decisions. I think this is important to point out that if you do not authorize someone to make medical decisions for you, medical care providers will be forced to prolong your life using artificial means if necessary. So if you wish to avoid this, you must have what's called advanced medical directives. You may find that 1, 2, or 3 different types of medical directives are necessary to carry out your wishes. So we're talking about managing your medical decisions and how that occurs. The the practical ways to do that are generally through 3 different documents. One is called a living will. Another one's called a durable power of attorney for healthcare. And the third document could be a do not resuscitate order, or a DNR. The living will allows you to approve or decline certain types of medical care, even if you may die as a result. So it's kind of stating what your wishes are. While the durable power of attorney for healthcare allows you to appoint a representative to make medical decisions on your behalf. So you decide how much power you want your representative to have, and kind of spell out some of your wishes ahead of time. And then finally, the do not resuscitate order is really a doctor's order that tells all other medical personnel not to perform CPR if you go into cardiac arrest. Now, there's two types of these. One is only effective while in the hospital, while the other one is effective and used outside of the hospital. So you got these 3 different documents. It's critical that all of your documents are consistent. So if there's language in them, you need to be able to make sure that that language is coordinated and they're all working together to facilitate your wishes and your needs. So that's managing your medical decisions. Let's talk about managing your property during the event of an incapacitation. It is important to have appropriate tools and documents in place to allow those whom you choose to manage your property should you become incapacitated. This can be done many different ways. However, we'll focus on 3 options here. The 3 options that we're going to talk about are living trust, a durable power of attorney for financial assets, not for healthcare in this case, but for financial assets, and the use of joint ownership. Focusing here on the durable power of attorney, this is an important document in that it allows you to name someone to act on your behalf. They get endowed certain powers to conduct certain financial transactions on your behalf while you either choose or not able to conduct them on your own. So we have a durable power of attorney, which is effective immediately. So you sign the documentation, you get all the appropriate signatures, and that durable power becomes live and can be used at any time. Then there's also what's called a springing power, which is effective upon your incapacity. And the thing to know about the springing power is that some states do not recognize springing powers. The other thing to be aware of as it relates to durable powers of attorney, or powers of attorney in general, is that they end at your death. So sometimes in talking to clients and prospective clients, there's a misconception that the durable power of attorney gives people the ability to do things after the individual has died, and that's simply not the case. Once death occurs, then the individual's will and other provisions will dictate who has the responsibilities to act. So this is very important to distinguish because I know you hear stories about people putting their wills perhaps in their safe deposit box at the bank. And oftentimes it becomes difficult for somebody who has durable power of attorney to go and access that because they no longer have the power to access the safe deposit box because they're after somebody died because their powers have ended. And then you get yourself into a situation where it's difficult to retrieve the necessary documents to go into the next phase of administration. We have living trust. A living trust is where you can transfer your ownership of your property to a revocable living trust. This is where you change the registration or the titling of the ownership on the property and name the living trust as the owner. Oftentimes, the person doing this will name themselves as a trustee during their lifetime and during the period of time where they have full capacity. But they'll name a successor trustee that will kick in when they're no longer able to act, maybe because of incapacity. This oftentimes is helpful to ease the transition of the responsibilities. And this is often helpful if you own property in multiple states as well, because it reduces the amount of perhaps administration that needs to go on even post-death in this case. And then finally, let's talk about joint ownership briefly. Joint ownership is just another option. It's just a way to hold your assets jointly with someone else, which would allow the other party to take control of the assets if you can't. So you gotta determine whether or not this is appropriate for your situation and if it's an effective way of dealing with the potential for incapacity. So all these are methods for planning ahead so that we can ensure that your wishes are carried out. Let's talk a little bit now about long-term care. This is a hot topic all the time, and it's at top of mind for many people. And you can see the statistics here. You can see that 52% of people who reach age 65 will need long-term care in their lifetime. 10% of people over the age of 65 have Alzheimer's disease, and that statistic actually increases to 33% for those over age 85. You can see the average length of time spent in a long-term care facility is about 2 years, but there's about 14% of people that need more than 5 years. So then when we break down and we look at the costs, looking at median annual cost, you can see adult daycare is about $18,000 per year. Assisted living goes up to about $45,000 a year. And then when you move into the nursing home scenario and you look at a semi-private situation, about $86,000 a year versus $97,000 for private. You can see these costs become staggering, and without appropriately planning for the cost, you need to, it could create havoc on your plan and also financial havoc for a surviving spouse or family member. So these need to be strongly considered. So there's really three long-term care funding options. One is to self-insure. Self-insuring for long-term care is a good option if you have the funds to do it. I would say that it is important to consult a financial planning professional long before retirement or before a potential long-term care situation arises to ensure that you've considered all of the complexities and ramifications of doing this. As I said previously, if for some reason you don't have enough funds or the funds run short, you could impoverish your surviving spouse or family member. Another way to go is the use of a long-term care insurance policy. And these have become increasingly expensive over time, and they have changed in the nature of how they are utilized and how they are structured. These policies typically pay for the cost of nursing homes, sometimes in-home care. You have to look at the benefits that they're going to cover. You have to determine how much of a benefit, oftentimes on a per-day basis, that the policy is going to pay. You got to consider, is there an inflation rider on the policy or no inflation rider on the policy? And if so, how much? You should consider the elimination period. This would be the period that you have to pay or self-insure before the policy kicks in. And finally, consider the total maximum benefit. While 2 years is the average stay, sometimes you may need to plan for more than that. The third funding mechanism here is government benefits. And I'm just going to simply mention Medicare, which has some very modest provisions for long-term care, oftentimes coming off of a hospitalization. There's a period of time where some benefits will be covered, but it's very limited. Medicaid is another program. Medicaid, though, sort of assumes that you're going to have to spend down a considerable amount of your financial assets before you qualify. And then those who have served us well, the veterans, there's numerous veterans benefits that could be available as well. So we need to look at that. So we're going to transition now to handling the loss of a spouse. The financial and legal matters of this. You know, this is a very stressful time. Lots of decisions have to be made, but it starts with planning a funeral. The stress of having a funeral plan. Some people pre-plan for their funerals. Some people write out their wishes and so on and so forth. This is all helpful to those who have to plan. The second part of this that's really important is getting organized. Being organized and knowing where to go to find the documents, the necessary documents that are required to begin dealing with the loss of the spouse or a loved one. Then you get into settling the estate and all the matters that go on there. Settling the estate could be filing the appropriate returns, whether they be as fiduciary returns or inheritance returns, whether they be state level or federal level. Lots of complexities there, and oftentimes it's advised that you get a qualified and competent legal counsel to help walk through that process. Paying income and estate taxes. You got to figure out where is the money going to come from, what assets will be liquidated, or what assets will be available to pay for income and estate taxes. Estate liquidity is very important when it comes to this. If all the assets are tied up in maybe a piece of property or a business interest or something, it could become very difficult to raise cash to pay the necessary income taxes. So this all has to be thought of and planned out as well. Filing claims for insurance and Social Security benefits. There again, we have insurance policies that may have been taken out on the deceased person. It's a matter of filing the appropriate claims for that. But finding competent advice in all of this is very important, and it's also helpful to walk through the surviving spouse during this time period, or whoever's settling the estate, because if you have a good, competent team of advisors, oftentimes can take a lot of the excess stress that accompanies this process at a time when people are still grieving. So it's extremely important to find the appropriate advisors. So now we're going to move on here, and Jim's going to wrap up here on receiving an inheritance. I'm going to talk about that.
Thanks, Scott. So we're kind of running a little short on time here, so I'm going to walk through this fairly quickly. But the final life transition that we wanted to cover was receiving an inheritance, which primarily usually involved, when someone passes away and names you as the beneficiary or one of the beneficiaries of an estate. So the first thing that you want to do when you receive an inheritance is understand what you're really receiving and kind of reevaluate your financial position. Just because you get, $500,000 from, your father who passed away doesn't necessarily mean it's time to quit your job and and kickbacks. You really need to kind of understand what you're getting, what the form of it is, and what its impact is going to be on your future. Tax consequences of an inheritance. Generally, there's not any tax consequences to inheriting money. There's not an income tax associated with it, and there's any estate or inheritance tax or things like that. That's paid at the estate level before the distribution will be made to you. So the tax ramifications will really be what does this mean going forward? What kind of assets are they? Are they income-producing assets? Are they non-income producing assets? Are they retirement plan assets? Retirement plan assets get a little tricky, in terms of inheriting those, and maintaining the tax-deferred nature of those, and how often you have to take distributions from them and so forth. So there is some more complicated tax issues associated with inheriting IRAs or 401k plans that you need to be aware of. What's the overall impact on my investment plan going to be? How is that going to change now that I've got an additional amount of funds that are going to be added to that? So you need to kind of take a step back, reevaluate where you are there. How is this going to impact your estate planning and insurance? Do you need to have more insurance now, or do you need less insurance now? Those are things that you need to be aware of. You need to be looking at changing beneficiary designations and things like that. How is this going to affect your estate plan? And what you plan to do with your assets at your death. What about education planning? Do you have outstanding student loans? Do you have children or grandchildren that you'd like to help out with their future education? So there's some decisions that you can make regarding that. And then the last thing, giving all of your or part of your money away or your inheritance away. Obviously, you don't want to do that until you know exactly how this is going to impact your situation. But if it's significant, obviously you may want to make some plans to sort of gift that to the next generation or to charity or those kind of things if you're not really needing those funds. So that's just kind of a brief inheritance things to think about as if you're expecting an inheritance. What we'd like to kind of wrap up with here is just kind of how do you go about choosing an advisor to help you with all of these different issues or with some of these different issues throughout your lifetime? And when you think of financial advisors or brokers or wealth advisors, what do those different titles mean? What are the different terminology in this industry mean? What is fee versus commission? What is an RIA, registered investment advisor, versus a broker? What is a financial advisor versus a wealth advisor? What's the fiduciary standard versus suitability standard? I mean, a fee versus commission is pretty straightforward in that a fee-only planner typically just charges either an hourly rate, or if they're managing money on your behalf, they'll charge you a flat fee or a percentage of the assets, as opposed to a commission, where the advisor is making money based on a product that they're selling you, whether that be an insurance product or a brokerage product. An RIA, a registered investment advisor, which is what our firm is registered with the SEC or the state securities commission in your state. They're a little bit different than brokers in terms of the RIAs, or we're going to flip over to the fiduciary standard. And what does that mean? With RIAs such as us are covered under what's called a fiduciary standard versus a broker or an insurance guy that would be more fall under the suitability standard. So with the fiduciary standard, you as an advisor, or we as an advisor, have a legal obligation to act in our client's best interest. We must put the client's interests above our own. And advisors must also do their best to make sure that investment advice is made using accurate, complete information, and that this thorough analysis is performed. As that compares to the suitability standard, which only requires that any recommendations are suitable for clients considering their needs, objectives, and unique circumstances. So it doesn't have to be in the best interest necessarily, it just has to be suitable for that kind of class of person. They also need to make sure that the transaction costs are kept to a minimum. So that typically is the basic difference between a fiduciary and a non-fiduciary. Who is Damani Wealth? This is Damani Wealth. We were previously Parenti Beard Wealth Management, changed our name a year and a half ago to Damani Wealth, as we separated from any association with the accounting firm that we were involved with We are an independent, fee-only registered investment advisor. We have locations throughout Central and South Central Pennsylvania. You can see the cities that we're located in. We are made up of a highly specialized technical team that includes people that are CFPs or certified financial planners, as well as CFAs, chartered financial analysts, as well as CPAs, given our, the fact that we came out of accounting firms, so we have a lot of CPAs on staff. We have AIS, which is an accredited investment fiduciary, CTFA, which is a certified trust financial advisor, and an enrolled agent. So we've got both a diversity in terms of investment and financial planning background, as well as tax backgrounds. Services are shown there. Retirement planning, kind of our main focus is retirement and income tax planning, estate planning, and wealth transfer. We deal with a lot of clients with philanthropy needs or wishes. Investment management is a big part of our business. Trust and foundation services, family office services, and business retirement plans such as 401ks and the like. So that concludes the presentation part of our webinar here. Now we'd like to open it up. We've got about 7 or 8 minutes left for questions if we've got any.
Thanks so much, Jim and Scott. We do have a few questions that have come in. Here's one about divorce. Most of our wealth is tied up in my husband's retirement plan at work. How do we split that up without paying significant taxes to the government?
Yeah, that's I touched on that when I was going through the divorce section of what's called the Qualified Domestic Relations Order, which is a quadro. Again, that's prepared by an attorney and approved by the judge. But that allows you that allows the retirement plan, whether it be the retirement plan or the IRA, to distribute money based on whatever amount it says, and whatever the instructions would be to either move it to another IRA or move it to another retirement plan or take it out in a lump sum. I mean, those are the things that you would need to understand the tax ramifications of. You'd want to, in most cases, probably roll that over, maintain the tax deferred nature of it, but it allows you to just tap in and pull out a chunk of that money so that in those situations you can come up with an equitable distribution.
Thank you. My parents have been gifting property to me and my siblings over the past 5 years. Is this marital property or mine alone when it comes to a divorce?
Again, when that comes to a divorce, anything received by gift or inheritance is separate property, so that would be yours alone from a marital asset standpoint.
Thank you. Let's see, here's a question about retirement. My husband is 63 years old and is considering retiring in 2 years. I'm worried because he has no interests or hobbies outside of work. Do you have recommendations on how we can address this?
Well, without knowing, your husband's personality, I think what I mentioned earlier in terms of being prepared psychologically to go from 35, 40, 45 years of reporting to a job and, either, working for people or having people work for you, and all of a sudden that goes away. I think, I would recommend that, it's not as easy as just finding a hobby. It might be that you maybe need to get involved with some charitable organizations or find something that you're passionate about. And again, retiring, I think this day and age doesn't necessarily mean stop working. It could be just that you start working at what you've always dreamed of working at, and the income part of it doesn't mean as much as the personal satisfaction part of it. So I would seriously start looking at some things that you've always wanted to do with your life or always wanted to help, whether it's helping other people or organizations or something like that you can keep yourself and your mind occupied and kind of keep that personal satisfaction level up.
Thank you. Here's another question about retirement. My wife will be 62 next year and wants to immediately begin collecting on her Social Security. I told her it's best to wait. What are your thoughts here?
Again, that's not unusual. I think people, want to start taking their money as soon as possible because there's this, thought in their head that it may not be there, down the road. So I might as well take what I've paid in. I want to get my money out. But it really needs to be a decision that's based on collectively what your household income needs are going to be in retirement, and can you afford to put it off because you want to. I mean, it just from a pure financial and economic standpoint, it makes sense to put off Social Security because of the substantial penalty that you take for taking it early. So at a minimum, I would try to get at least to 67, by postponing to your full retirement age, unless circumstances are such that there's no other options. You have to retire, and that you've got to start supplementing your income, so you've got to start taking it. So I mean, it's a tough question to answer without knowing all the background, but that would be my thought process in terms of going through that.
Great. Let's see. Here's a question about changing jobs. I've recently accepted a new position at a different company. I still have a balance on my 401k loan. What will happen to the loan balance when I leave my employer?
Yeah, so unfortunately, when you find yourself in that situation with a loan, and we usually try to discourage loans as much as possible in retirement plans because you run up against this particular situation. But what will happen is either the trustee of the plan or the custodian of the plan will attempt to collect the remaining or outstanding loan balance, which sometimes, most of the time when there's loans involved, there's typically not other assets available to pay back that loan. So therefore, if the loan cannot be paid back, what happens is it becomes a deemed distribution. And the ramifications of a deemed distribution would be that it's income that gets included as part of the other income for the loan or for the plan participant, and subject to tax. But oftentimes, if the person is less than age 59 and a half, then it's also subject to a 10% penalty as well. So depending on the loan amount, depending on income situations, there's the possibility also that it could drive you into a slightly higher, another marginal tax bracket as well. So there's some very, very nasty side effects that could occur in this type of a situation. So if it can be cleared up, that's the best alternative, but that's not always a possibility.
Great, thank you very much. It looks like that's all we have time for today. If you submitted a question that we weren't able to get to, someone from Damani Wealth will be in touch with you to help you answer that question. Again, you'll be receiving a recording later today as soon as that's ready. Thank you so much, Jim and Scott, and thank you, audience, for participating today. Have a great day.
Thank you.
Thank you.